So you've probably never thought to yourself that omelets, taxes, and real estate go together, but as a matter of fact, they can. And if you'd like to find out more, then you're going to want to watch this week's video on cost segregation studies. Hi, I'm John Norberg, and welcome to the Financial Prop Series. So in this week's video, we're going to talk about one of the most powerful strategies for real estate investors that they can use to potentially lower their tax bill substantially, and that is the cost segregation study. So what is it? Well, here comes the omelet part. Think about it like an omelet, where instead of being able to take a write-off on just the omelet as a whole, now we're going to break apart the omelet and write off each individual ingredient inside the omelet. So the bacon, the cheese, the tomato, the peppers, the onions, or whatever else might happen to be in the omelet of the day. Now we're taking all of those separate ingredients and depreciating each one, that is writing off each one on its own individual schedule. Sound a little bit weird? Well, let's give this analogy a little bit more color. In our analogy, the omelet is the house or property, rental property that you're purchasing, and each of the individual components, you know, the onion, the pepper, the bacon, etc. Those are all of the things that are depreciable according to a separate schedule inside the house. So a couple of examples might be furniture, flooring, landscaping, roof. All of these things may be able to be depreciated on a much shorter schedule than the standard, which for a rental residential property is typically 27.5 years. So what does that mean? Well, if we use the cost segregation study tool, it helps us segregate or set aside those different individual components, those omelet ingredients, if you will, so that we can write them off separately from the write-offs that we're already taking on the individual property as a whole. So now, let me give you an example of how this might work. Let's say we have a rental property that we purchased for with a depreciable basis of $1 million, right? And we had a cost segregation study done, and that study came back with, okay, there are $300,000, let's just say, of individual ingredients or components inside this house. Again, that could be flooring, furniture, etc., etc. That could be depreciated on a separate schedule, say 5 to 15 years, typically. Now, if you're in the top tax bracket of 37%, just depreciating that property as you go along, you're going to be able to save, roughly $11,000 per year if you just take a standard write-off according to that 27.5-year deduction schedule, depreciation schedule. So what happens if we do a cost segregation study? Now we can write off those individual components on a much faster basis than would otherwise be the case. So, for example, with that $300,000 cost segregation study component section now identified, we can write that off at, let's just say it was all 5-year depreciation schedule things. That would equate to approximately $60,000 in the first year that you could then write off. And if you're in the top tax bracket of 37%, well, now we're talking about over $10,000 in actual tax dollars that could otherwise go to the IRS that you could save by having done this cost segregation study. So that's pretty cool, right? Again, $1 million depreciable basis property, right? $300,000 that the cost segregation study identified as having different depreciation schedules. So, again, furniture, flooring, cabinets, etc. And now, from that $300,000, we can write off $10,000, or sorry, $60,000 or so dollars, which means a $10,000 year one deduction if we're in the top tax bracket of 37%. Now, this gets even better when we figure in bonus depreciation. And right now, bonus depreciation in 2024 is at 60%. So let's take that same example, right? $1 million property, $300,000 of depreciable assets on a separate schedule. In other words, cost segregation study identified $300,000 of ingredients that could be depreciated much quicker, let's say 5 years. That would equate to an actual tax savings of over $180,000 potentially, or $180,000 even rather. This could, in theory, then mean that you, if you're in the top tax bracket, again, federally, that's 37%, could write off over $66,000 in actual tax savings. So again, the write-off, would be $180,000 with that 60% bonus depreciation, and $66,600 would be, a little bit more than that actually, would be the actual tax dollar savings to you in year one. Versus if you just broke up that $1 million over the 27.5 years of the depreciable schedule of the property, that's much, much less that you'd otherwise be able to write off. So this helps illustrate why and how so many of my clients have considered and have oftentimes even gone through with cost segregation studies to help illustrate where are the property items inside that house, that residence, etc., that might be depreciable on a much quicker basis, thereby putting more money in their pockets in a quicker manner. Now, yes, it is true that if you go and sell the property, that some of that depreciation is going to have to be recaptured. In fact, typically it's all of the depreciation that you've done, and then anything on top of that is considered capital gains. But good news, even the depreciation that you're recapturing is typically going to be treated more favorably, because for the property as a whole, rather than the individual cost basis items or cost segregation study items, there is a cap of 25%, even if your regular income tax bracket is 37%. So it gets a little bit more nuanced, and there are a few more details that probably want to talk about in there if you are considering the sale of a property post-cost segregation study. And there are some tax strategies that can really help make the most advantageous sale. And again, we can talk about those on a more one-on-one basis if that's your situation. But bottom line that I want you to get out of this video is that if you are a rental property owner and you haven't considered a cost segregation study, or maybe your accountant has told you it's not worth it, or maybe, for example, you thought it's just simply too expensive based on what I actually get out of it, or too time consuming, they can actually be quite cost effective, especially when you consider the benefits that you get out of them and how quickly a cost segregation study can help put the money back in your pocket. So if you're curious about this, I'd love to hear from you. Drop us a line, and in the meantime, like and subscribe as we release videos on these tax saving strategies, on these financial strategies throughout the year. And in the meantime, I'll see you out there.